Ladies and gentlemen, good day and welcome to the Q4 FY22-23 earnings conference call of the Karur Vysya Bank. We have with us today the management team of KVB, represented by Mr. Ramesh Babu, MD and CEO, Mr. Natarajan, President and Chief Operating Officer, Mr. Ram Shankar, CFO, and Mr. Srinivas Rao, Company Secretary and Compliance Officer. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. B. Ramesh Babu, MD and CEO, to take us through the highlights of the quarter gone by, after which we will open the floor for questions. Thank you, and over to you, sir.
Thank you. Thank you very much. Good evening to all of you. On behalf of our Karur Vysya Bank, I welcome you all to our bank's earning call for the quarter 4 of financial year 2023. I am pleased to mention that bank has been consistently performing well during the 4 quarters of the year 2023, and the outcome numbers in terms of growth, profitability, and asset quality are in tune with our guidance. You will be glad to note that bank has in the exit quarter achieved 1.5% ROA, 16% ROE, 4.37% NIM, less than 45% cost to income, with overall business growth of 16% and 4-digit net profit for the year and for the first time. We have declared 3-digit dividend subject to shareholder approval. I am sure you will not disagree if I say that the outcome was on account of our conscious efforts, which we are explaining to you in our earlier calls. All of you would have gone through our detailed presentation on our Q4 and full year of performance. I would like to share some of my thoughts on the performance of the bank during the quarter and our guidance for financial year 24. Net interest margin increased marginally by 1 basis point on sequential basis during the quarter at 4.37%. Based on our historical pattern of renewal of deposits and fresh deposit acquisition, we expect that there will be a further increase in the cost of deposits to the extent of 40 to 50 basis points in the next 2 quarters, assuming no change in our deposit rates. As we already passed on interest rate hike to majority of the loan book under EBLR and MCLR, there may not be an equivalent increase in the yield on advances. Yield on investments have gone up by 39 basis points during the year, and it is estimated to go up by 25 basis points in the next 2 quarters. Considering all these factors, and without taking into any policy rate changes, we expect a compression in our NIM in the next 2 quarters, and accordingly, we estimate that our NIM will be in the range of 4% in the next 2 quarters. We have achieved ROA of 1.5% in the exit quarter, and we expect that we will continue to maintain this during the year 2024. In spite of estimated lower margin, our estimated business growth, fee income, lower credit costs, and recoveries in written-off accounts will support us to keep ROA at 1.5% levels. Our adjusted growth in advances for the year 23 was at 16%, and it could be noted that there was an inclusive growth across business segments led by MSME and agriculture. On account of various initiatives bank has taken, we expect to continue this trend in these segments supported by retail and corporate, and we expect a growth of 14% for the year 2024. Our deposit growth was at 12% during the year, and term deposits and CASA deposits were grown by 15% and 6% respectively. We expect 14% growth in deposits with higher growth share in CASA segment. As indicated earlier, bank has created consumer banking department by merging personal banking liabilities and personal banking assets. A set of senior and experienced officers have already joined to head the CASA acquisition, corporate salary accounts, government business, third-party products, etc. The structure is in line with large private sector banks having sizable CASA book. We are in the process of recruiting down the level sales team and feet on street. In the first phase, we have planned for 1,300 resources, and of which 480 resources have already joined and another 820 resources are expected to join before September 2023. In view of this, we will be incurring an additional expenditure of about 61 crores, which is a full year cost. Though the cost to income ratio will go up marginally this year, and we expect that it will be helpful for the bank to scale up the CASA book to 40% over a period of 3 years and better growth in third-party product business. Our cost-to-income ratio for the quarter continues to be below 45, and considering our business expansion plans, we expect that the ratio will be in the range of 45 to 50 for the year 2024. Our slippages are under control, and our gross slippages for the year, it was at 75 basis points, and net slippage ratio for the quarter is at 0.06%, and for the year it is negative. Our estimated slippages during the year 2024 will be in the range of 1% of our loan book, and we are confident that we will continue to keep the ratio below 1% in view of our better underwriting, customer engagement, monitoring, and collection process. During the year, we have recovered a sum of 208 crores from the technically written off book. For the quarter under review, we have provided a sum of 287 crores towards NPA migrations, restructured accounts, and standard assets. For balance sheet management and tax benefits, we have made certain prudential provisions, and on account of this, the credit cost is at an elevated level of 146 basis points. Our net NPA book now is at 468 crores, and expected lower slippages and better collection system will support us to keep credit cost at 75 basis points for the year 2024. We continue to maintain net NPA at less than 1% of our loan book, and gross NPA will be less than 2% at the end of year 2024. Our standard restructured loan book is further reduced to 1.5% of our loan book, and we hold a provision of 21% for the standard restructured book. Our CRAR continues to be robust and is at 18.56%, providing us a comfortable headroom for growth. Our liquidity is well managed, and our CD ratio is at 85%. Our digital systems are helping us to scale up our business volume with ease and better control. We continue to add many new features in our Delight app, which is our customer onboarding application. We have recruited Chief Digital Officer from the market and exploring other digital fields which shall support our growth and enhance customer experience. During the year, we opened 10 branches, and we propose to open around 35 to 40 branches in the coming year, besides opening a couple of digital banking units during the year 2024. Bank has recommended a dividend of 100% subject to the approval of the shareholders. Other business performance highlights are given in our presentation. Let me conclude by saying that our performance has been consistently improving over a period of 8 quarters, and I repeat that the numbers are as per our guidance. A set of experienced executives are managing the business, support and control functions of the bank, and the details are furnished in our presentation. We continue to outperform our past performance, and I am grateful to all the investors, analysts, and stakeholders for the confidence and continued support which we will reciprocate through our better performance in the days to come. Now, I will be glad to respond to your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, you may enter star and 1 to ask a question. We will wait for a moment while the question queue assembles. Participants, if you wish to ask any questions, please enter star and 1. The first question is from the line of Mayank Kulkulia from SBI Life. Please go ahead. Mayank, your line has been unmuted. Please go ahead.
Yeah, hi, I'm audible?
Yes.
Yeah, audible. Please go ahead, Mayank.
Yeah. Hi, sir. Congratulations on good set of numbers.
Thank you.
Yeah, we have 50% of our loan book in MCLR. Can you share breakup of reset period in terms of 3 months, 6 months, 1 year?
As already indicated, 47% of our book is in MCLR, and the EBLR book is 37%. And in the case of the MCLR, the last time we have made the changes in the month of March. March we have changed the MCLR, and out of that, next 6 months, I think completely will be repricing will happen.
And Mayank, understand, the majority of the working capital loans which are linked to MCLR, so on an ongoing basis, depending upon the renewal, when it comes, it will be happening. So that way, we cannot talk about a fixed bucket that way, because the cost of deposits, what all are there, we are passing on to them. So still, some more headroom is available for the MCLR loans to be repriced, whereas EBLR has already been passed on. So that way, we will take care of that. Next 4 months at least I can say, because last year from more or less October onwards, the MCLR spike started. So next 3-4 months, the renewals of 1 year, what all will happen, we will be getting the benefit for the next 3-4 months.
Okay. So next 2 quarters, probably deposit repricing will happen faster than the loan side, and probably net interest margin will be 4% plus. So like going forward, we'll be able to maintain net interest margin of 4% plus even after 2 quarters as well.
The visibility, first of all, Mayank, if you look at it, absolutely it's a dynamic world. Now the deposit, in which bucket it comes and what rate it comes, you will not be knowing now. So based on the past trend, you cannot say that the deposit will go into a particular bucket. So depending upon his scheme, what all is there, they will be going. So that's why what we thought is the visibility is there for the next 2 quarters. We thought wherever some loose ends are there in respect to the loan repricing, likewise with MCLR and other EBRR, wherever some concessions are there, where we can withdraw, these sort of homework we can do for improving the yield. Likewise, on the cost of deposits, where you have no control because the renewals will be happening, fresh deposits also will be happening. So conservatively, we thought that our endeavor is to maintain that 4%. Maybe once second quarter is over, we will have a better clarity and visibility, then we will guide you.
Sure, sir. And in terms of like growth, just trying to understand like whether in Tamil Nadu market competitive intensity have increased much higher than the like rest of India. So is the market becoming more competitive because it's more lucrative? So what thought on that?
I agree, but you understand we have been here for the 107 years. So that's why our footprint and base is here. And not only Tamil Nadu, we are based out of our footprint is there in other states also. So currently what all is there, the customer connect what we have and how our people are able to attract the business and all. So more or less every segment we are able to do that. One more thing what I found is, so last year was also more or less a competitive year. So in many of the verticals, if I see, the disbursements have gone up by 40 to 50% over the previous year. So last year was also competitive. So that way, we are fine-tuning our product, other things also. So with that, we feel that we will be able to continue our tempo. And that is the reason, the indication what all we have given, that 14% loan growth. So not only Tamil Nadu, other areas what all we have, so we will be able to grow. That's what we feel.
Okay, thanks a lot. I'll come back in queue.
Thank you. Thanks, Mayank.
Thank you. The next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Hey, good evening, sir.
Yeah, good evening, Mr. Mahesh.
How are you?
Fine, thank you. How about you?
All well, sir.
Thank you very much.
Simple, good, great numbers. Just three questions from my side. One is, what would be the income from written-off accounts for the quarter, sir?
Quarter is 100 crore odd.
100 crore, 108 crores.
So the total here is 208 crores, and 100 crores odd has come during this quarter.
Okay. And what would be the outstanding stock of technical written-off now?
No, but Mahesh, my point is the technical written-off per se, if you look at it, may not be a good indicator. The reason is, it may look like 3,000, 3,500 crores, something like that. But the problem is, majority of the old corporate accounts were under consortium, which are there with NCLT, you may be getting 5%, 10%. So that is still uncertain how much you will be getting there. So that's why if you look at it, overall the realizable portfolio we can think of is around 1,500 crores portfolio, where we can do some sort of an exercise and we will push it. Rest of them, so depending upon various other factors and all, so because corporate is there, so many of them may not be able to get that. So we will focus on that in the next 2 years also, on all these things. But one thing I'll assure you, so last 2 years, we have given enough effort on wherever we have a security. By enforcing security, surface and ports, all these things. So majority of them are in different stages, and people are coming forward for the OTS also. So that way, this year also we feel that this progress, what all we have made, will continue under the write-off for this 24 also.
So just to clarify, this 1,500 crores of possible recovery pool that is sitting there, you could say that you could hit a number closer to 200 crores again for next year?
Yeah, definitely.
That is possible. Okay. And my last question is, 110 crores for provisions for restructured accounts. Any specific reasons for it?
Nothing like that. Actually, you see, so earlier when we were looking at our past, on an average 15 to 20% we were actually delinquency was there. So what we thought is a good year that way. So it is better we make up that way, so that if at all unforeseen eventuality we take a hit also, so we need not worry about that, because now the restructured book has become a minuscule portion of our total book at 1.5%. Out of this portion also we keep it aside. It should not bother us at all. With that intention only we have kept it.
Perfect. And in this 976 crores of outstanding restructured, what is the outstanding provision sitting now, including this 110 that you made this quarter?
21%. 21% we have provided out of this.
So about approximately 200 crores then.
That's it. Correct.
Okay. Perfect, sir. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Jay Mundra from ICICI Securities. Please go ahead.
Yeah, hi sir. Congratulations and
thank you, Jay. Thank you.
Sir, just to clarify, 200 provisions is on 976 crore, right? So
True.
Net of provision, the number is even lesser, right?
Very correct.
Sure. Secondly, sir, on your loan mix, on your 14% loan growth, do you envisage any sub-sector to grow at a slightly faster pace, or you think the loan mix would more or less be similar?
Jay, if you can look at our past performance, where our corporate used to be 30, 35 and all, finally in this quarter it has come down to 21%. Earlier it used to be 22. So that way, our first focus would be on the MSME commercial banking group, because where our yields are better, and many places our 9.5, 10% also will get the yields and all. So after that, we are focusing on our retail segment, because retail mortgages are doing well. Now jewel loans also we are going to focus. And third thing is agriculture. Agriculture, because there are two advantages. One is the gold loan, and other agri also we are focusing on that. Last year was a bad year as far as the PSLC is concerned. Otherwise, we were making some money out of the PSLC also, in addition to taking care of our own PSLC. So in the order of preference, if you look at it, commercial, followed by retail and agriculture, and then corporate.
Right. Okay. And sir, your growth, right? So you have a staff cost for FY23 at around 1,000 crore.
Okay.
You said that we are adding few people, 1,300 people in the staff, and hence you would have an extra 60-61 crore OPEX number for next year. But how should one look at the OPEX growth for next year? I mean, one part is of course slightly higher because of the proposed staff addition. But in general, as loan growth is, let's say, 14%, how should one look at the OPEX growth?
So OPEX, Jay, in fact, generally our OPEX to assets is in the range of 2.3, 2.4. So here, maybe it will be in that range, slightly elevated here and there, but we have to see a bigger picture. What we are planning is, these feet on street we are going to engage. They are going to work on the CASA as well as the third party also. So what all we are going to spend, more or less to the extent what all we are spending, we will be getting on the income side also. So it may look OPEX is on a higher side, but our focus is on the fee to income also, fee to assets also, how to grow. So overall, after doing all these adjustments, we thought that 1.5 ROA we will be able to manage with this increased cost also.
Sure. And lastly, sir, on your credit cost guidance of 75 basis points, isn't it? I mean, you already have a net NPA which is, let's say, 75 basis points, and you have a 20% coverage on restructured.
Correct.
And even at this quarter, you have seen almost negative or negligible slippages, or negative slippages including PWO recovery.
Correct.
Right. So your credit cost guidance, is it more conservative, or you think, basis look at the portfolio, the credit cost, incremental credit cost can be, much lower than what you are suggesting?
No, I agree, Jay. You see, we are in the first quarter. Then during the whole year, what will happen, at least we will not be able to estimate at this stage. Though our endeavor, you see, our 0.56 is our SMA. We would like to have a tighter control on that, but still you may have to provide for some sort of standard assets, migration assets, these sort of things will be there. And with this, we thought that at the max it may go up to 0.75. It may not go also. So that's why we took it, saying that maybe after 6 months, we will have a better clarity, we may give a revised guidance for this. But this is what for the whole year, very unknowns, if at all comes up also, we want to factor them. That is the reason we have given a 0.75.
And lastly, sir, related to this, you must be doing a parallel run to the ECL framework, right? Every 6 monthly. Is there any, what could be the pro forma provisioning under Ind AS versus the IRAC? Is there any meaningful difference?
CFO will respond, yeah.
Not a major difference we find officially from what we are submitting to RBI. We'll be able to manage with the whatever provisions what we make. We don't see any big change in the new system comes in.
So there is not material one-time transition provisioning needed, right? Is that what you're saying?
But Jay, my point is the guidelines itself, they are not out on what basis you need to do. The back of the envelope, when the risk management and those people, they have done that, they found saying that the existing provisioning, what all has been made, would be relatively sufficient. There will not be any big shocks which bank will not be able to absorb. So that was the understanding we had. So now it unfolds as and when some sort of a guidelines come up and all, we will be able to know that. But currently, that is not a major issue which is going to impact the bank.
Sure, sir. And the SMA number that we disclose is the total loans, right? Including below, correct.
Total book.
Okay. Thank you, sir. Thanks a lot.
Thank you, Jay. Thank you.
Thank you. Participants, if you wish to ask any questions, please enter star and 1. The next question is from the line of Pranav Tendulkar from Rare Enterprises. Please go ahead. Pranav, please.
Hello?
Yes.
Hello? Yeah. Can you hear me?
Pranav, we are able to hear you. Please go ahead.
Yeah. Sir, I just have two questions. So one is that you have actually highlighted that you are investing more in the people for cross-selling and Python Street. So also, can you just highlight what are the targets to cross-sell various products that we have in our bouquet, and how are we tracking how many branches are actually enabled to sell all the products in our bouquet? Thanks a lot, sir. Thanks a lot.
Yeah, I agree. So Python Street, when we are taking the different sets of people are coming, maybe for the trade and forex, corporate salary, other accounts. That way, each one, depending upon the profile of the customer whom they are going to market, particularly the CASA. The Python Street, what we are acquiring is for the CASA, and their focus will be majority on that. The products which we are going to focus are the life insurance, general insurance, and the mutual fund. These three would be the major products. Now, currently, enablement is concerned. We have already partnership with many of the partners in each of the life, general insurance, everywhere partnerships are there. So recently we have entered into an arrangement with SBI Life also to add bouquet to our total portfolio. So now every branch is equipped to handle that, not that a particular branch can do it. We are going to utilize our analytics also in this process, what can be done, the next best product will be offered, and this Python Street also will be on the job. Together, we want to give a focus on this. But one thing I'll tell you, the Python Street actually they'll be coming into the field, and most probably from up to September in the process, the recruitment process is going on. But those whoever have already come there are converted from the existing lot, they are on the job, and we will be monitoring on the third-party income.
Right, sir. Sir, last question from my side. So, sir, 2 years ago, there was a competition increasing in our core competence market, which is SME, MSME in South. So, how is competition panning out right now? Thanks a lot.
Yeah, and that's it. Now, in fact, I agree. At that time, the position was relatively different because the COVID was there. Other banks were unable to grow. There were no other opportunities. That way, at that time, the people were poaching onto those accounts. Now that the market is opened and all, everyone has other opportunities. That sort of a competition still we were facing at that time. Because at that time, particularly we were facing on three counts. One is on the pricing, rock bottom pricing, quoting and taking. And second thing is the lowest security coverage. And third thing is undue enhancement. So we were looking at the quality of the portfolio. If by doing this one, if we do it and all, we'll be having a problem tomorrow. We were leaving the accounts. But all those issues have come out. But even today, if that sort of an undue enhancement where someone do not require, we are still not allowing that, because though not today, tomorrow it will be a problem. So that sort of a cutthroat competition going on the pricing, all these things have come down to major extent, because other banks also, they are facing the heat of the enhanced cost of deposits. So that way rock bottom pricing and all, that issues have come down now.
Super, sir. Thanks a lot.
Thank you. Thank you.
Thank you. The next question is from the line of Prakhar Agarwal from Elara Capital. Please go ahead.
Yeah, Prakhar. How are you?
Prakhar, your line has been unmuted. Please proceed with your question.
Hi, sir.
Hi.
Am I audible?
Audible, Prakhar. Please go ahead.
Yeah, hi, sir. So most of my questions are answered. Just one couple of things I missed out in between. So what is the growth guidance that we have set for FY24, which is one. And second is in terms of, I don't know whether you've answered this earlier, any impact of ECL that you probably would have seen.
Yeah. In fact, both were answered, but it's good. I'll repeat once again. So the advances, what we thought is 14% plus we wanted to grow. The same is the case with deposits, so that we will be able to maintain the CD ratio of around 85%. As far as ECL is concerned, our CFO has clarified the working what our risk department does it. So they found out with the current framework what all has been spelled out. So our provisioning currently what all is there will be able to take care of this one, and there may not be many major shocks for us to absorb that ECL provisioning. So that's what, but as and when these guidelines unfold from Reserve Bank of India, so we'll be looking at that. But one good thing, Prakhar, what I can say, the transformational journey what we have performed, with this, that total cleanup has happened now. We have sufficient muscle to take care of these shocks if at all comes up also. Had it been 2 years back, our position would have been shattered totally. So now we are relatively much better to absorb this sort of a shock comfortably.
Sure. So, and just two more questions. In terms of margins, when I look at Q4, the reported number is 4.37, and we say it's increased 1 basis point sequentially. But when I look at last presentation, it was 4.32. Is that because of the base adjustment that we have seen during the quarter?
Correct. Actually, I'd like to clarify here. Based on the RBI Master Circular on the financial statements presentation disclosure, interest accrued but not due on advances and deposits have to be reclassified, and we had undertook that in the March quarter. There's a small difference in the numbers what we reported in December and the revised number.
Got it. So on a revised number, that margins would have been 4.36 last quarter.
Correct.
And sir, if I look at your presentation, slide number 15, so again on advances, we have given that 66,000 odd crores and after write-off 64,000 odd crores. And then a similar number we have given us 64,000 crores.
Correct.
What exactly is the difference between the two? Is that a previous classification and a new classification? Sorry, that I missed that number.
No, this is only the whatever the technical write-off which we have done in the current year, that we have added back to show the exact growth, fresh growth, because whatever growth we have done this year, because of technical write-off of 1,800 crores, it appears at a lower side. Just to ensure, show the correct growth, what we have done in this year, we have added back and shown it as advances.
So that number is 66,000 crores, but if I look at 64,420 crores, what exactly that number is?
64,
including, 64,420.
So, you see the difference is only the technical write-off.
So after technical write-off, it is 64,168, which is similar. But if I look at two columns, which is there in slide 15, one is 66,031 and the other is 64,420. Just wanted to understand the difference between the two.
You are right. We'll come back, Prakash, on this number. Huh? Okay, please.
Sure, sir. That is it.
CFO will send a communication to you. Otherwise, what our intention is that 1,893 crore, what all has been written off, had we not done, our growth is 16% actually, because 1 year is a good year, we thought of clearing up. Intention is to convey the message, but anyhow, CFO will clarify that point separately to you.
Sure, sir. Not worry. I'll take it separately. Thank you so much.
Thank you. The next question is from the line of Rakesh Kumar from B&K Securities. Please go ahead.
Yeah. Hi, sir.
Hi.
Thanks for the opportunity, sir. So, first question was related to the SAR deposit blended cost. So, what is the SAR deposit blended cost now for this quarter?
SAR deposit, savings bank is at 2.5, current account is not there. Because savings bank, our average rate is 2.5, and current account we don't pay anything.
No, only for SAR balances, because there are, different rates we pay for the different balances. So what is the blended cost that we have on SAR?
Our average cost for this is 2.57.
For the SAR deposit?
Yeah, for the SAR product, the cost is 2.57 for the Q4.
And how much it was in the previous quarter, sir?
It was the same range, because we are not changing anything during this entire 1 year. Because, for example, Q1, it was 2.55. Now it is Q4, it is 2.57.
So last, I think we changed in January sometime, 28th of January or something.
No, that we have added only one bucket. For example, more than 100 crores, we have created a separate bucket. Otherwise, we have not changed anything in the lower categories.
Okay.
Yeah.
Okay. And secondly,
One second, Rakesh. Our CFO has to clarify.
Before that, the previous Prakar had asked for what the difference on the fourth column. There is the 2 crores of technical write-off what we done in Q4 alone. That we have shown separately. The last two columns talks about the growth in quarter-on-quarter growth. The first column talks about the year-on-year growth. That is the difference.
Thanks. Yeah, please, Rakesh, please go ahead.
Yes, sir. Thank you, sir. So secondly, sir, wanted to understand the capital consumption pace that, because of the return ratio number, we were adding, capital every year. So this year we have seen, some depletion in the capital, core capital number. So is that, due to kind of a selection of credit that we are doing. So what is the reason that, we have seen, pretty sharp rise in a credit risk, number? So if you can help us understand.
Rakesh, you see, we have shown in the table risk-weighted assets movement, 53 has become 54%. That 1% cannot be considered and construed as a sharp rise. Okay. Earlier, when the COVID and our subsequent period, the focus was majority on the gold loans, where the capital risk weight was not there. So that was the reason the share has come down straight away in the graph. Now that across the board, all verticals we are growing, so naturally there is a slight growth in the credit risk-weighted assets. But one thing also we need to understand, if it is too low, the risk-reward ratio also will be low, you will not be able to make money. So we need to strike a balance between the risk and what sort of pricing where we can manage, so that you can optimize your yield and you can protect your name. With that intention, keeping in view how to maintain the asset quality, the yield and the top line growth, all together we are going ahead. But we need not think saying that there is a sharp spike in the risk-weighted assets. It is just 1%.
No, sir. I was referring only to the credit risk rate, sir. So if you look at it has gone.
Under that you find a table there. You will find a table we have shown that credit risk rated assets how you have moved. It has moved from 53 to 54%. That's all, 1%.
No,
graph it shows.
No. I'm saying, sir, only about the credit risk rate, sir, which has increased from 34,000 to 41,000.
Now understand, see, generally that 100% weightage for the general credit. For example, whatever the MSME loan we are doing it. So that increase is 7,000 crores is reflecting our growth in the MSME sector and the corporates and the other retail.
Okay. Thanks, sir. Thanks a lot, sir.
Thank you. The next question is from the line of Madhu Chandarde from NC Pro. Please go ahead.
Hi. Congratulations on
Thank you.
Good
very
performance.
much.
Yeah, I just had a couple of questions. One is FY23 has been an exceptional year for the banking industry. In terms of record high margin, record low credit cost. Looking at FY24, although you have given specific guidance, what are the niggling worries that you see going ahead, which was pretty much not there in FY23? That is my first question. And the second question is, deposit has been a challenge for the system and it has been a challenge for you also. You are, revamping the organization, adding feet on street. But are these the answers to the deposit challenge, and how confident are you about your deposit guidance of 14%? These are my three questions.
Fine. Thank you, madam. In fact, one thing I just need to say, for the banking industry, 22-23 may be an exceptional year, but for us it's all the more exceptional. The reason is the baggage what we were carrying in the earlier years. So last 2 to 3 years, the journey what we had to perform, lot of cleanup has to happen in addition to other things also. So the baggage also we could clear and we are in a decent position now. So the worries, if you look at it, as it is, if you look at three broad parameters, if you look at it, business growth, profitability and asset quality. So I talk about asset quality. So we have formed the collection teams and centralized and a vertical head has come last year. So from then onwards, we started seeing a lot of improvement in our SMA 1 and 2. So then we started focusing on the SMA 0, which flows into SMA 30 plus. So that way we have got a fair control on what the asset quality, because these only will flow into this one. And next thing is the corporate used to be a big pain for us at a point of time. So under that, now the corporate SMA has come down to the minuscule. So that way the bigger worry what we used to have has gone out. Now what all we are acquiring now, so what we did in the year 2019, we have gone for a loan origination system with checks and balances with a tie-up with many other agencies with a surrogate data to check what we are doing is correct or wrong. So what we do on an ongoing basis, we will do an analysis of pre-2019 what all accounts have been underwritten and post-19. So when we see particularly the commercial banking and the retail. If you look at it, pre-2019, the stress may go up to 4%, 5% odd. And subsequently, what all we have booked with all checks and balances, so this is more or less around 0.5, 0.6. At these levels, it is there. Maybe in the process, we may not have grown so well because we have not opened the floodgates. But what all we have acquired, we are reasonably confident that has only helped us during the COVID period without having much sort of a stress under that. So with all these things in mind, so the asset quality should not be a major problem for the bank. Now coming to the business growth. So we thought that having brought the momentum vertical-wise for each vertical contributing, we thought that each vertical will be able to contribute 14%. That should not be an issue, but provided if the market and economy also supports. Then the question comes, the worry part is the cost of deposits, where absolutely some sort of a visibility we can have for the next 6 months. And beyond that, we do not know how it pans out, whether the rates, how it moves out and all. So now there is a limit also. Beyond that, you may not be able to pass on the yield to the advances on the pricing. So how much you will be able to pass on, how you are going to maintain the NIMs at these 4%. This is one of the worry which we need to keep in mind. But we are looking at other factors like fee to assets and how to improve the NII also by improving the yield. These things we started working on, address the particular issue of cost to deposits and NIM. Now coming to the deposits, I agree with you. There is a fierce competition in the market, and last year also, though we were trying our level best for the CASA, so many of our customers, other banks were wooing them for shifting them into the time deposits at higher rate. Then after 3 months, we ourselves realized instead of losing the relationship, it is better we only convert them into time deposits, though it involves additional cost for us, but we try to do that. Now, the people, the feet on street, everything what we have told them, these are the people actually in the field. So currently what all is not there, even if they add a grain of gain to the gain, overall it will be a gain, and that sort of the fee income as well as the CASA, this is what our intention. So currently first the set of people who have come, if you look at it, their performance is reasonably okay, but we need to test the waters for another 6 months. So we are hopeful that, so with the initiative what we have, that the deposit growth what all we have planned will work.
Hello. This is the operator here. Sir, we could experience audio loss from your connection, so we'll reconnect your lines in the meanwhile.
At what stage they have
We have the management line reconnected, so you may proceed.
Madam, in fact, can you just tell me which are the points you have missed? Because I thought that I understood that intermittently the call got missed. If you can tell me which are the points you have missed out of my what all clarification I have provided, I am willing to clarify that once again.
No, sir. If I think, it was just parts of the sentences which were not audible fully, but I could make a sense of what you were trying to convey. So if I understood you correctly, from all the initiatives that you have taken, deposit growth and at what cost remains the key worries as we look to FY24. Is that what you wanted to convey?
No, I just want to clarify here. Deposit cost at what cost? Suppose if you are acquiring the CASA and if you add this cost for the acquisition also, if you add, it may be slightly costlier. That is the reason what we are working is, those people whom we are acquired now, they will be focusing on a third party also, that income also they will be generating. And they will also get some other business. So we want to make that vertical what all we are creating self-sustaining and profitable on its own within a 1 year. So that way, initially 1 year there can be lead lag. Otherwise, some subsequent years onwards, it will be working on its own.
Okay. And sir, just one last question. The unionized employees and the cost, etc., had been a kind of an issue with the private sector bank like yours. So if you could just clarify going forward in the next couple of years, what is your take on the employee cost increase? What kind of increase should we factor in?
Ma'am, in fact, for the last 4 years, if you can look at it 3-4 years, whomever we are taking them on a CTC basis. So we are not taking them on the IBA basis and all. So that way, so those who are coming, they are absolutely linked to their performance and all. So not only that, the existing team also, we need not think like unionized and all, because the productivity of the people have gone up like anything. If you can look at our presentation in the last page, the business per employee and the profit per employee, how it has moved. The same set of people it has moved. If you can look at it, our 2017, our total staff strength was 8,000. Now it is 7,700. After 5-6 years, it is 300 down. The productivity has gone up by manifold. So if you look at the costing also, more or less we will be able to manage this establishment cost, what all is there for them. And with that itself, we feel that 1.5 ROA what we have conveyed. So we will be able to achieve that.
Just one small housekeeping here. Of the 7,700, what percentage is IBA and what percentage is normal CTC as you mentioned?
Madam, 90% is IBA only.
90% is still IBA, right? Okay. And given the retirement profile of these people, what would it be in maybe in the next 3-4 years' time?
That all we have to see it, because we also thinking of that. We will have to see that, ma'am, because our current focus is how to get the productivity from the existing team rather than meddling this thing and all. So if we can get the best productivity from them and we are able to maintain our ROA, all these things and all. So we will try to see that, then we can think of addressing the rest of the issues.
Okay, thank you, sir. Thanks and all the best for the next year.
Thank you very much. Thank you very much.
Thank you. The next question is from the line of Krishnan ASV from HDFC Securities. Please go ahead. Krishnan, your line is open. Please go ahead.
Yeah, hi. Am I audible?
Yeah, Krishnan audible. Please go ahead.
Yeah, thanks. So my questions are more to do with cost of deposits on one hand, and just in terms of our current MCLR, what is the pricing that we have on MCLR, and where is the current blended book on your MCLR portfolio, which is 47% of your portfolio?
So what is it you want to know about cost of deposit?
Just in terms of for a 14% kind of growth that you are building in, given your CD ratio 85%, right? Where is it that you expect your cost of deposits to settle over the next year?
Fine.
The reason I'm asking that is, obviously we are in an environment where there is a scramble for deposits. For some banks, it is showing up disproportionately higher. So just wanted to understand in terms of what you are seeing in the market where you are looking for these deposit pools.
Yeah, first question I'll respond, and second one our president will respond. First one is on the cost of deposit. If you can recollect our guidance, what initially I have mentioned there. So we were saying that with a back of the envelope work when we did it, with the current renewal pattern for the existing deposit renewal and the fresh inflows, what all are coming, which will land into which bucket. So we thought on an average around 40 to 50 basis points growth may come up in the cost of deposit, but simultaneously I was also mentioning the losers, what all are there in the pricing of the loans. That also we are going to tighten up. So that is the reason we were indicating an NIM of 4%, but with the existing rates on deposits, you can expect around 40 to 50 basis points going up in the next 6 months to 8 months.
Helpful. On the MCLR?
MCLR, our president is going to respond.
See, as indicated earlier, so our MCLR books is something around the 47 the percentage. So based on the reset class, whatever we have arrived, and out of this 30,000 crores, almost 15, I can say 25% will reprice within the next 6 months period. That is up to September. That's what the initial working we have done. So currently we are charging the MCLR is 9.35%, and then if you take the blended rate, it will be something around 9 to 9.2%.
Understood. That's helpful. Just the other thing, I think this kind of resonates with one of your earlier questions as well. Just in terms of credit costs, with technical write-offs, you have a coverage of about 90% plus 92.
Yeah,
right?
true.
The 75 basis points again for FY24 seems to be overshooting your. I mean, so is that excessive conservatism at your end, or is there any uncertainty in the M&E? I'm just trying to understand.
No, absolutely. All of you be very clear. Absolutely, there is no uncertainty. We also do not have an iota of doubt about the quality of the credit. If it is there, it would have reflected comfortably in the SMA 30 plus. So that apprehension, none of you need to have. It is more or less on a conservative basis we have given. We do not have any sort of apprehension on our portfolio.
Krishnan, in addition to that, see, there are certain tax benefits are available. If it is rural advances, something like that, we need to provide the minimum quantum. And secondly, if you see, we have indicated 1% slippages for the entire year. So wherever the new slippages are coming, we need to provide for that. But recoveries, whatever is coming, it will go to the technical written off account. So in that way only we have just estimated the number, not because of any specific stress we are seeing.
Correct, absolutely. So that apprehension no one need to have, because we ourselves, we don't have any apprehension about that.
There are certain migration provisions we need to make. So all these things put together only we are doing it.
Got it. If I could just squeeze in one more question.
Please.
This is to do with how you read the environment for MSMEs right now, given the kind of steep hike in pricing that MSMEs have seen. How are MSMEs doing in terms of their own health today vis-a-vis what you might have seen, say, a year back?
Yeah, Krishnan, one thing we need to understand, the bank's pricing is one of the factors for the MSME in the whole scheme of things. Now, suppose if he is going to get the business and he is able to make money out of this pricing of 1% here and there doesn't make any sense. Whenever we deal with few other MSMEs, they are dealing with NBFCs paying at 13, 14, 15% also. With that, they are making money. So that way, this 1% on account of that MSME is going to collapse. That's a myth. So this is not going to have. There are few sectors which are doing well, and we focus on that where their margins are better and they are established. So that way, this pricing, higher pricing on account of delinquency till date, because last 6 months, 1 year we have been passing on. So on account of this particularly coming sort of a weakness and delinquency, which we didn't find, because provided if they are profitable and making money, this 1% doesn't make any difference for them.
And you're saying that the current economic environment allows them to absorb that?
Correct.
That's good.
Provided that's what the economy, what all is there, it runs well, and all few other sectors they are doing well. If it runs well, they will be able to absorb. And many of them, when we talk to them also, this 1% here and there, it is not a matter of big concern for them.
Understood. That's helpful. Thank you.
Thank you.
Thank you. The next question is from the line of Anand Dama from MK Global. Please go ahead.
Yes, sir. Congratulations for a good set of numbers.
Thank you, Mr. Anand.
Yeah. Sir, I have a question on the cost. I think you said that this year basically the cost income ratio actually would go up, primarily because you are expanding people on the ground and trying to get more business. Is there a deviation or basically reset that you're having for this year where you want to expand business and where you're basically investing more in the people? And if yes, how do we look at the cost income ratio or cost to asset ratio going forward after I think you've done the reset in FY24?
Yeah, I agree. So you're perfectly right, because a few other initiatives what we have taken. So those things initially an investment we have to make for the future. So in the process also, but earlier you would have seen, Mr. Anand, that our cost to income ratio used to be 50 to 54 and all. But even then we have given a cautious guidance that our cost to income ratio will be in the range of 45 to 50. It will not cross, because rest of the levers on the income side also we are working continuously. So going forward, we feel after the 24, these investments what all we make and they start yielding the results. the cost to income ratio can be in the range of around 45. Our intention is to maintain that in the range of 45, that range.
Okay, sure. And so secondly, is it possible for you to give the SMA book number, including the low value accounts below 5 crores?
Everything is SMA. What all we have given that number, it includes even 1 rupee loan also.
Oh, is it? Okay, great.
Including 1 rupee loan. So you would have seen that this SMA number, actual number, is lower than March 22, though book has grown.
Great, that's interesting.
Because our current SMA number is 360 crore. Last year it was 470. The advances have grown to 66,000, but even then the SMA has come down to 360, which includes every loan account, every vertical.
Sure, sir. That's great. Thank you.
Thank you, Mr. Anand.
Thank you. The next question is from the line of Chintan Shah from ICICI Securities. Please go ahead.
Hello. Yes, sir. Congratulations on good set of numbers.
Thank you.
Thank you for the opportunity. Sir, just one question. Actually, I joined the call a bit later. I'm not sure if I missed this number. Have you given any guidance for 24 or ROA guidance for FY24?
Yeah, absolutely. So what we did, you see, the cumulative for the whole year ROA has come to 1.27. For the exit quarter, it is 1.5. So last year also the exit quarter, what all was there, we have given a guidance we will try to maintain during the rest of the year, and that way we finally landed 1.5. So for next year, the guidance given by us is 1.5 plus. That's what we want to maintain for the whole year of the next year.
Sure. And sir, secondly, I just wanted to understand what would be total provisions on our entire book, and can you break it up into the specific provisions and restructured provisions and any other provisions?
Yeah,
the buffer.
See, on the standard assets, on our overall book will be around 1% of the advances of the provisions.
Okay, that is the standard asset.
Yeah.
No, I mean, so in absolute terms, if you could just quantify, I mean, in standard, specific, towards restructured, any other contingent provisions, what will be the total pool of provisions on the book? Any number on that? On our 65,000 crore book?
It will be around 620 crores, yeah.
No, 620 crores. And it cannot be, okay?
No, sir, standard on 330 and another 650.
Total provision book is only 620 crores.
Other than NPA, only the standard.
So other than NPA, what he is saying is 620 crores is because NPA anyhow separately we are given 92% of the provision coverage we are given. Other than NPA, that's why what he is saying, around 1% of the standard assets we are maintaining as a provision.
Okay, and this includes 200 crores of restructuring as well, right?
Correct. Because restructured also is a restructured standard.
Standard
restructured.
Yeah. Sure. And sir, one last question on the retail portfolio. So our retail portfolio has grown roughly 16% for the year. And if you look under that, other loans, which is roughly 1/6 of the retail portfolio, that has grown 34%. And while housing loan has only grown 12%. So any color on what the other loan comprises and where is the growth coming from?
Yeah, there are few loans. Again, it's a time deposit. Few of them, they wanted a loan and all, they took it. So that was the reason that growth has come up. And if it includes some staff loans, they comprise of small portion, but other loans comprise of majority.
The deposit only major.
Deposit, loans against time deposits.
Okay, loan against time deposit.
Correct.
We have multiple products, running account product and the fixed product and all. It's a combination of all.
Sure, sir. I think that's it from my end. Yeah. Thank you, sir.
Thank you, Chintan. Yeah.
Thank you. The next question is from the line of Sushil Choksey from Indus Equity. Please go ahead.
Congratulations on stable results, sir.
Thank you, Mr. Sushil.
First is, sir, what is your likely estimate digital spend for transformation journey?
No, for digital, you know that we have initiated the year 2018. So most of the capital expenditure at that time we already spent. So currently whatever we are doing is to maintain the operating expenditure only we are doing it. Currently we are not planning for any major capital investment except for a trade finance. Now recently we are tied up with a company and then we are now in the process of implementation. Otherwise, there is not much cost involved other than the operating cost.
Another one also, this corporate internet banking also, we are working on that. These two. And one thing I tell you, Sushil, we have, that is the reason to have more focus on this particular area. So we have taken from the market a chief digital officer who will be focusing on what are the investments we are making, what value we are going to get out of that, what the expectation of the customer, what others are doing, to look at the whole gamut. He has just reported a month, 2 months back, and once he works, he'll come back with a plan. Based on that, what all investments are required, we will do. But somehow we felt that the investments, what all we have made, we need to get some more value out of that. That is the reason the first task what they are given to CDO is to get some value and simultaneously look at what investment we need to make. Maybe another three months and all will crystallize on that count.
So for your specific reference, for example, in the year 2021, we have invested around 50 crores, which includes all other IT. In the year 22, we have invested 43 crores. In this year, last year, we have invested 53 crores. So roughly 40 to 50 crores is our total IT spend.
Standard average is 50.
Correct.
Second thing, the rates internationally or domestically have peaked based on MPC or Fed or whatever norms you want to take. So what's your outlook on Treasury specifically based on our current book, based on our CD ratio?
See, you have noticed our investment book all along, we are maintaining a very low duration during the past 2 years. And now we are trying to replace our the low yielding security with at the time of maturity with yielding security. That is why if you notice, last year there is a substantial increase in the yield from 5.1% to 5.80. So what we have guided is based on our initial estimates, in the next 2 quarters, another 25 basis yield will go up based on our current book. So we have around 2,000 crores surplus SLR, and the duration we are keeping it very low. For example, if you take AFS, is only less than 1. Only in case of HTM, it is at 3.2.
Okay, in view of the elections coming up next year and global and domestic environment specifically, they take auto ancillary, some value-added farm produce, and the MSME sector which we are supporting, be it in domestic or manufacturing. Would you front-end, because the rates are high and expectation will be lower in the second half, accelerate your credit growth more in the first half, or you would not look at it that way?
It's not like that actually. So we are actually planning, we need to see that by July ending, we are more or less at 1,41,000 crores business levels as at the end of March. So we thought saying that by end of July or just middle of August, whether we can cross that 1.5, that is 1,50,000 crore, that's what actually we are internally planning. So once we plan and get that, so as you said, it gets front-ended because the advance are growing, correspondingly we need the deposits also for the 85% CD ratio. So we are on the job to front load it, but the question is, we want to balance it in such a way that there is no dilution in the quality of the acquisition and simultaneously to grow. And before August, we are trying to do this exercise.
Thank you for answering all my questions and all the best for the years to come.
Thank you very much, Mr. Shil. Thank you.
The next question is from the line of Arvind R from Sundaram Intranet. Please go ahead.
Hi, thank you for the opportunity. I just wanted to get a better color on the SME book. What kind of industries are we lending to, and which will be the top 3 or 4 industries or sectors will be the book is focused on. And I want to understand the other loans have actually grown faster rate year on year in comparison to all other books. Are they predominantly credit cards? What kind of loans does it represent? And on cost of funding part, so I was able to see a lot of banks was trying to focus on time deposits. I understand that you have spoke about this throughout the call, but I still want to understand what kind of thought process went into this 40 to 50 basis point increase in cost of deposits. So basically, if all other banks are, focusing on time deposits because their rates are high and, the competition is high for CASA. So, how confident are you, with the 40 to 50 basis point? I thought it could be even higher.
Agreed. Understood. I'll just respond and the President will add also. The first point, what you mentioned, the commercial majority, the way the MSME is growing. So actually, the majority is coming from trade, that is wholesale and retail trade, transport operators, commercial real estate, and under the manufacturing, the textile, food processing, construction, basic metal, and metal products. These are the main sectors. Actually, we are growing there. So these things are good because we are reasonably confident and we have some certificate in the trade. So that business, lot of business we are getting it. Now food processing also, a lot of scope is there. We are growing in that. Now coming to the unsecured, if you look at it, I can say that the personal loans in the retail sheet, what you are seeing, there is a row called personal loans, which is around 337 crore. That is the clean portion of the book. And rest, if you look other loans and all, other loans comprised of two portions. One is the loans given to the staff members, and second thing is against the time deposits. And these two are the main. Otherwise, there is no much unsecured sitting there. And you can look at another slide where we have shown the security and unsecured portion also. Another slide is there. You can find how much is a very minuscule portion of our unsecured portfolio. So that way, these other loans need not be a factor to be worried because it is backed by either security or time deposit. Now coming to the cost of funds, what you are mentioning, 40 to 50, as I was mentioning earlier. So our ALM department, they did some sort of a homework based on the past renewals, what were happening, and when the renewal is happening, in which buckets they are growing, and the current inflow of deposits, what all are coming, they are coming into which buckets, and what is the rate of interest. Looking at all these things, we thought, saying that there can be a spike in 40 to 50 basis points in the cost of deposit. That was the working we have done. No.
Yeah. See, Arvind, if you notice, during this year, our yield on advances has gone up by 120 basis points. Whereas our deposit cost has increased only by 52 points because of the lag effect. It's an industry scenario. So what we are trying to work out is based on our historical data, maybe the renewal pattern and all these things. We estimate that in the next 2 quarters, there will be increase in the cost to the extent of 50 basis points based on the lag effect. And there will be some corresponding yield also because of the MCLR. Entire thing is still not passed on. Still, I can say some 40 to 45% of our MCLR book on the respective due dates we will be passing it on. But we have conservatively we estimate that that 50% it may not be possible for us to completely pass on to the MCLR. But of course, we have other factors also. For example, I was mentioning about yield on investments. So yield on investments will support us by another 20-25 basis points. So overall, we are just for conservatively, we are estimating it, and then we are trying to work out how to minimize this lag effect.
Yeah, so thank you. But just one more question. By the numbers you have mentioned, so 16% is roughly fixed book. So all of the fixed book is repriced by now, or whether it will be repriced, in the next subsequent quarters.
Fixed and then MCLR, EBLR, and 15% of our fixed book.
Correct. So fixed price, mostly, for example, if you take a retail loan, vehicle loan, we take a fixed rate. So we don't change it during the tenor of the loan.
Likewise,
and staff loans,
time deposit loans also.
Yeah,
fixed term.
Correct.
So you cannot change during the currency of the loan because the underlying time deposit, what all is there over and above with the markup, we will give a loan there. So it will not undergo change even if they are agnostic to MCLR and EBLR changes.
No, I understand that. I was trying to understand in the subsequent quarters, if there is going to be, there will be maturities, right, in fixed book also. So is it
Some maturities are there. The fresh acquisition, what all we are going to do will be at the current rates only.
Yeah, I was trying to understand what would be the impact of that. That's what I was trying to understand.
Don't worry, there is a small book of that one and all. our ALM working, they're going on. But keeping all these things in mind only, we thought that 40 to 50 and NIM of 4%, that's what we were indicating.
Okay. Thank you so much. Thank you, sir.
Thank you very much. Yeah.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. P. Ramesh Babu, MD and CEO, for closing comments.
Yeah. Thank you very much. And first of all, a profound thanks to each one of you for taking out time and showing interest in our bank. So just to conclude, so I just want to reassure that the transformation journey plan has been showing promising results. The loan book is improving towards SME and retail, granular corporate book with better asset quality. And with all these things and benign asset quality, granular deposits, structural changes, what all we have brought out for a revamped business model and a strong capital base, with all these things, bank is well poised to go forward, and we will continue the journey the same way. And what all we have been guiding, we will go ahead on the same line, and we will try to deliver that. Thank you once again to all of you.
Thank you very much. On behalf of the Karur Vysya Bank, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.